Look, while everyone was glued to their trading apps this week, something massive just happened in Basel, Switzerland that nobody's talking about. This isn't speculation or some wild theory, it's an actual regulatory change that becomes law the moment trading starts Monday morning. They kept it quiet on purpose. They didn't want everyone freaking out, but they had to do it because the entire financial system's foundation is about to shift. If you've got cash sitting in any bank right now, you're part of this whether you know it or not. The organization calling the shots is the BIS, the Bank for International Settlements. Basically, they're the people who tell central banks what to do. They're literally the Federal Reserve's boss. And they just activated the last stage of something called Basel III. Everything's about to be different. Let me break it down simply. For the past 4 decades, major financial institutions have been running a massive con. They've treated paper agreements for precious metals like they were the actual physical thing. They'd hand you documentation saying you owned gold, but the actual gold bar? Not sitting in any vault. They were trafficking in promises instead of products. Total fraud. But come Monday, that scam falls apart. To get why this destroys their whole operation, you need to understand how banks measure their financial health. Until now, a bank could possess these paper promises, what the industry calls unallocated gold, and present them to regulators as secure holdings. Maintaining these positions barely cost them anything. This let them control prices artificially, dumping billions in silver contracts they never actually possessed to suppress market value. But the updated regulation modifies something called the net stable funding ratio. Yeah, I know, sounds like the most boring thing ever. But stay with me here, because this is where it gets wild. Under the new system, holding these paper positions becomes incredibly costly. The banks face a brutal choice: either purchase the actual physical metal to support their bets or exit the market completely. They implemented this rule to prevent another 2008-style meltdown. But in doing so, they've triggered a time bomb. Giants like JP Morgan and Citi can't maintain billions in short positions anymore without backing them with enormous amounts of actual capital. The expense of price manipulation just went through the roof. What used to be essentially free to suppress silver now costs an absolute fortune. We're watching the consequences unfold in real time. Banks are frantically closing out their positions in after-hours trading. They're scrambling to meet compliance before the Monday cutoff. This creates buying pressure that keeps building. What's pushing the price isn't retail investors speculating. It's the banks themselves trying to avoid regulatory penalties. But here's where it gets really interesting. This is the part mainstream media won't mention. The most significant aspect of this regulation is how it reclassifies gold itself. Up until yesterday, regulators treated gold as a risky holding, similar to a volatile equity. Starting Monday, gold becomes a Tier 1 asset. That designation means it's now considered zero-risk capital, identical to holding physical currency or U.S. government bonds. Consider what that psychological shift does for banking executives. Before, their incentive was to sell gold to keep prices down. Now, the regulatory framework rewards them for buying it to improve their financial statements. They're transitioning from price suppressors to asset hoarders. When the world's biggest sellers suddenly flip to become the world's biggest buyers, the price floor doesn't just increase, it becomes permanent. This explains the strange market activity from last week. Remember when liquidity completely dried up? Trading basically froze. That wasn't some technical error. The market makers deliberately stepped aside. They canceled their sell orders because they knew this regulation was incoming. They didn't want to be holding the wrong positions when the new framework went live. They were adjusting their trading systems for a new environment where physical metal dominates. And it's not just banks paying attention. Massive industrial players like Tesla and Samsung aren't clueless. They're reading the same regulatory documents. They understand that once banks stop flooding the market with paper silver, prices will shoot up to match actual physical demand. We're seeing emergency buying from industrial manufacturers right now. It's literally a race. You've got manufacturing facilities on one side desperately trying to secure supplies for electronics and vehicles. On the other side, you've got banks vacuuming up physical inventory to satisfy their new capital mandates. There's not enough silver available for both groups. The math doesn't work. The Western financial system is essentially admitting defeat here. China's been operating this way for months already. The Shanghai Gold Exchange exclusively trades fully allocated physical metal. They never participated in the paper contract games. By passing this regulation, Western authorities are acknowledging that the Chinese approach won. They're conceding that paper derivatives are hazardous and physical metal is the only genuine security. So what does this mean for regular people like you? Sure, it makes the banking system more stable, but it crushes currency value. To acquire the gold and silver they need, banks must liquidate other holdings. They'll dump dollars. They'll sell off treasuries. This creates enormous downward force on the dollar. It's a balancing act. As gold and silver get revalued upward to achieve Tier 1 status, the buying power of the dollar supporting them must decline. When gold gets revalued, your cash savings get devalued. And there's a particular risk if you're holding metals through a bank. If you maintain an unallocated silver account, you're in serious danger. Banks now have every incentive to terminate your account. Your unallocated silver represents a liability under the new rules. Don't be shocked when you receive notification next week stating, "We're ending our precious metal services. Here's a check for the cash equivalent." They don't want to store the metal for you anymore. They need it for their own balance sheets. You won't see coverage about the net stable funding ratio on evening news broadcasts. It's too technical and wonky. It's not dramatic enough. But this is the infrastructure of the entire global financial system. Media outlets will focus on volatility, but they won't explain the underlying cause. The fundamental reason is straightforward. The age of paper leverage is finished. The age of physical assets has arrived. Last night marked the end of the infinite leverage era. This is genuinely historic. This carries the same weight as 1971. That was when President Nixon severed the dollar's connection to gold. In 1971, the government moved us away from metal backing. Now, over 50 years later, Basel III is moving us back toward metal backing. It's a complete reversal. It's a gradual bureaucratic return to a gold-backed system. They're just not labeling it as a gold standard. They're camouflaging it as banking compliance reform. The central banking officials aren't foolish. They recognize the debt levels are unsustainable. They see the system trembling, so they're preparing escape routes. And those escape routes are constructed from gold and silver. Because banks are withdrawing from manipulation due to these new expenses, we're finally going to witness genuine price discovery. What does that actually mean? It means the real, honest price. In the near term, expect turbulence. We might see wild volatility as the paper short sellers rush to close their positions, but the long-term direction is locked in place. Prices must increase. They have to reach a level where physical supply matches physical demand without all those paper contracts diluting the true value. That price is substantially higher than $85. But there's a complication. This regulatory change impacts your finances in an unexpected way. Because banks must maintain more actual capital, they'll have less available to lend. This rule change creates a credit squeeze. Starting Monday, mortgages become harder to obtain. Business loans become harder to secure. The money supply is contracting. This generates deflationary pressure. Economic activity slows. But the Federal Reserve won't allow a complete crash. They'll counter this slowdown with inflationary money creation. Slowing economy combined with money printing equals stagflation. In a stagflation scenario, you don't want equities. You don't want bonds. You want silver. It's historically the best performing asset during this exact economic climate. The intelligent strategy is to mirror the banks. If banks are required to hold physical metal, you should hold physical metal. If banks are abandoning paper contracts, you should abandon paper contracts. Never bet against the house. The momentum is shifting toward tangible assets. They've enacted the legislation. The framework has transformed. Monday morning launches a new era. Banks are racing to comply. Short sellers are covering. The physical market is tightening. This isn't conspiracy mongering. It's a regulatory restructuring. The paper game is finished. The physical game has started. But there's a dangerous trap here. A doom loop the banks accidentally engineered for themselves. It's a specific situation where following the law actually destroys the bank. I'll walk you through how that mechanism operates in a moment and why it forces the Fed to create trillions. But first, you need to grasp the London loophole that just got eliminated. For years, the London Bullion Market Association, the LBMA, operated with a built-in advantage. They had a loophole permitting unallocated gold to count as a premium asset. This was financial sleight of hand. It enabled banks to lease identical gold bars multiple times over. It was a paper pyramid scheme. Basel III eliminates this advantage. It requires that for an asset to qualify as Tier 1, it must be allocated. It must be physically present in the vault. No promissory notes allowed. This forces London banks into a desperate search for physical inventory. The days of fractional reserve gold banking are concluding. When London demands physical delivery to satisfy these new ratios, the drain on worldwide vaults will accelerate at an unprecedented pace. The entire $100 trillion derivatives market depends on stable collateral. By forcing banks to maintain better collateral, gold and silver, Basel III makes derivative trading prohibitively expensive. We should expect a massive deleveraging event. Hedge funds using cheap leverage to short silver are facing serious problems. Banks will no longer provide them with low-rate financing. They'll be compelled to liquidate their positions. This short squeeze will be powered by banking system mechanics, not just investor sentiment. The major players already understand this. Sovereign wealth funds across the Middle East and Asia have been positioning for this regulatory shift. They knew that once gold achieved Tier 1 status, its value would need to rise to support global balance sheets. They've been front-running this regulation for 2 years. Now that the rule is active, expect them to go public. When a fund managing $1 trillion shifts just 1% into silver, the market explodes. And while Basel III targets gold specifically, silver benefits by connection. Historically, they're linked. They trend together. As gold reclaims its position as money for central banks, silver reclaims its position as the ultimate money for ordinary people. The ratio between them will compress. Investors will recognize silver as simply the undervalued counterpart of the new Tier 1 asset. We're observing the quiet remonetization of the entire precious metal sector. Now back to that doom loop I referenced. Ironically, these regulations were created to strengthen banks. But in the short term, they make banks incredibly fragile. Many banks simply lack sufficient physical metal to meet requirements. To acquire it, they must purchase it on the open market. But their buying elevates the price. And since they still maintain short positions, rising prices damage their balance sheets. They're caught in a trap. To comply with regulations, they must destroy their own positions. This generates a cycle where regulatory compliance pushes the bank toward bankruptcy. The Fed will probably need to create money to help them acquire the gold. This is inflationary. It also exposes a conflict, a division within the establishment. You've got Basel III pushing for hard assets like gold, but you've got other elites pushing for CBDCs, digital currencies. The commercial banks want gold for survival. The central banks want to control digital currencies. In this battle between banking factions, individual investors, that's you, can actually come out ahead. You win by holding the one asset both sides desperately want, physical metal. With these new regulations, the auditors are arriving. Regulators are going to inspect vaults to verify the metal actually exists. We suspect banks have been counting leased metal as owned for years. It's like renting a vehicle and claiming you own it on your financial statements. It's fraud. When auditors show up this quarter, the double-counting fraud gets revealed. A bank unable to prove it possesses the metal will either be shut down or bailed out. Demand for audit proof, genuine physical bars is about to explode. And don't overlook the mining companies. This regulatory change incentivizes miners to bypass public sales. They'll sell directly to banks. If JP Morgan needs 50 million ounces to satisfy their new Basel III requirements, they won't purchase it through exchanges. They'll contact the mine and buy the entire annual production. This eliminates the middleman. It leaves zero supply for Apple, zero supply for Tesla, and zero supply for your neighborhood coin dealer. The squeeze on regular investors is going to intensify. Banks are going to monopolize supply to save themselves. The rule technically launches Monday. Full implementation will take several years. But markets are forward-looking. They price future reality into today's prices. Smart money isn't waiting for the final deadline in 2026. They're positioning right now. By the time the complete impact makes headlines in 2026, silver prices will likely already be in triple digits. They've passed it. The era of paper manipulation is ending, not because banks wanted it to end, but because regulators forced the issue. Basel is the trigger that forces system-wide honesty, and honest money means dramatically higher prices for gold and silver. Banks are buying. Nations are buying. The question is, are you? History repeats in patterns. In 1933, the government seized gold to revalue it. In 1971, they abandoned gold to print unlimited currency. In 2026, with Basel III, they're remonetizing gold to rescue the system. Every time the rules change, there's a massive wealth transfer. People holding paper assets lost everything. People holding physical metal preserved their wealth. This regulatory change signals the wheel is turning again. The system is acknowledging that fiat currency has failed. They're retreating to the safety of hard assets. Why implement this now? Because inflation is persistent. Central banks know they cannot restore inflation to 2% without collapsing the entire economy. So they're changing what qualifies as safe. By making gold and silver Tier 1 assets, they're establishing a new anchor for the financial system that can withstand a decade of elevated prices. If banks are hedging against inflation with metal, you should be doing the exact same thing. For 40 years, U.S. Treasury bonds were the ultimate safe haven. Basel III challenges this assumption. By elevating gold to the same level as bonds, regulators are acknowledging that bonds are no longer the sole, risk-free asset. This triggers a massive rotation. Capital will flow out of the bond market and into the metals market. We're discussing trillions of dollars. If just 1% of the bond market shifts into silver, silver prices double immediately. You've heard whispers about the global reset. This is it. It isn't one dramatic event. It's a sequence of mundane rule modifications. Basel III is a critical component of the reset. It reestablishes gold as the centerpiece of the financial system. It shifts us away from a US-dominated dollar system toward a neutral asset-backed system. This levels the playing field for nations like China and Russia, which maintain massive metal reserves. The West is surrendering economic advantage to the East through regulation. The document is signed. The rule is live. Banks are moving. The window to position yourself before institutions is closing rapidly. Once the full force of the banking sector enters the physical market, you'll be priced out. Don't wait for news outlets to guide you. News is written by people who want to purchase your silver at discount prices. Examine the rules they passed. They passed them for a reason. Follow the money, not the propaganda. Buy what banks are buying, not what they're selling. But Basel III is just the defensive shield banks are using for protection. You also need to understand the offensive weapon they're constructing to attack your privacy. While they're securing their gold, they're preparing a new digital trap for your checking account that bypasses the traditional banking system entirely. It's called Project Icebreaker, and the details are absolutely terrifying. Click here to discover how this new digital currency system is designed to lock you in and how you can opt out before it launches.